Let's hope that they don't. There's certainly, I think the issue is that they're kind of between a rock and a hard place, right? So inflation is running quite high, over 8%, even core over 6%, and inflation expectations continue to rise. So it really kind of makes sense for them to raise rates because their concern is that we let inflation run too rampant. The unemployment situation will be even worse than if they're raising rates now.
Sure,
so
but you know what one of the points is
tough.
I've been thinking about and hearing people talk about is that Powell is so concerned now with the credibility issue, right? They lost a good amount of it because they waited so long and were so wrong in the transitory call that they're overcompensating for the credibility while jeopardizing the broader economy and the markets as they try and fix their own credibility. They're only human.
Yes. It's very tricky, and I don't know that they'll get to over 5%, which is kind of where some people are certainly going, implying that they'll get to. What's interesting to me is like the key two factors that they impact in the economy are, I guess, three, right? It's housing, autos, durable goods, and then financial conditions in the credit markets. And, housing kind of needed to slow. It's starting to slow, but you could argue maybe it wouldn't hurt too much for it to slow a little bit more. That might be net of benefit for society. Autos were going to come down kind of anyway. Mm-hmm. So, maybe that's a little bit more, but there's room for that to move down. And then in credit, I think the issue is that we've had credit extended at such low rates for so long. We've created, a lot of companies that just do not have reliable business models. And at some point that flushes out. It needs to flush out. Mm-hmm. And maybe it's like better sooner rather than later. So I'm as concerned as anyone that they could go too far too soon. I don't know that we're there yet, but I think we're maybe getting closer. And I think that the rates we're at right now, although the unemployment is a lagging indicator, many of the negative impacts are lagging. I don't know that we're at a point right now where it's dangerous yet. As we saw from the bank earnings this morning.
Well, it's funny when you use the word dangerous. We, in the last week or so, a couple of weeks, we've been hearing words that are dangerous, right? Financial stability. Lack of liquidity.
Yes.
Are you worried about the kind of bond market volatility that we've seen and something breaking as people have been talking about and worrying about?
Yes. I would say global bond market breaking, that would be concerning. Certainly, kind of overvalued bonds in the United States, corporates, less of a systemic concern. So that is something I think the Fed is watching. I think that there's a lot of international pressure and, hopefully something there won't break. But I do agree that does seem to be the biggest risk rather than just the U.S. economy by itself.
Are you feeling any better about where we are from a market standpoint? Or are you still as cautious as you've been?
Right. We're still actually pretty cautious while remaining, increasingly optimistic in areas that we think are really have been sold off potentially too much. And the reason we're still cautious, is you look at the markets as a whole, and we spend our time looking at individual stocks. But we think that inflation. Well, just go back to we think the normal run rate of inflation is not going back to 2% or 0%. Maybe it's 3 or 4%, which makes sense to have a Fed funds rate kind of maybe around where it is right now. And given that, valuations of many companies are just too expensive. So I just thought that they have to potentially reset, and they haven't fully reset yet. At the same time, and I feel like a broken record given all the commentary today, but areas like the banks, areas like, and this is not as much commentary today, but areas like consumer retail that have kind of are trading like there's already going to be a massive recession, potentially present some opportunities and, interestingly, potentially more safety, especially those that are more conservatively managed.
You like the banks?
I like certain banks. I like very conservatively managed banks that have, sticky deposits that aren't going to flee and have really been very conservative on their credit. And I think that, that there are opportunities there. And Wells Fargo is a name that we like in particular. I feel like a broken record today, but it is still a very cheap stock.
Yeah. You and Kramer, right? Yeah. Kramer was tweeting about it. His club owns it. He loves it.
I know. But it's really not universally loved. The banks as a whole aren't universally loved. But I think you still do have to pick your names. You probably still want to be cautious on banks that have too much international exposure. That might go well, right? Things in Russia might get better. The global economy might be fine, but there's more risk there. Also, banks with high deposit betas where deposits are fleeing. I think that's a really risky place to be. So picking your spots, but I do think that there is some opportunity in the more conservative institutions.
They have, I know it's maybe a shrinking part of their business, mortgage underwriting.
Yes.
So if mortgage rates are soaring, doesn't that hurt that part of their business?
Yes, but I mean, yeah, but it's not material compared to the rest of their business. So, and then their own loans. I mean, they underwrite a very low loan to value ratio. So yes, I mean, we do expect that anyone who's in the mortgage business is going to be having a much slower business moving forward.